Okay, folks. Okay, so we are going to officially begin right now. So, where is my. Okay. So, first and foremost, right, welcome all to the webinar, right? Profitable and practical trading strategies for the part time trader. First and foremost, I want to say, right, this is a disclaimer, right? This is the disclaimer, right? I know you're not going to read the entire disclaimer, but let me summarize it what's about, right? It's basically to cover my own, cover myself, right? In case right, you use any of the knowledge, I will not be responsible for any of your wins, losses, and etc. Everything is entirely on you, and right, we're all responsible for our own decisions. So I'm not responsible for any wins or losses that you may have. So yep, the webinar, and this is me, right? My name is Rainer. I'm an independent trader and ex-prop trader, and I'm guessing most of you probably right come across me from my website or on my social media profile, right? Twitter, Facebook, right? YouTube, etc. So that's it, right? First and foremost, I think I just want to share with you, for those of you perhaps who are new, right, to let you know a little bit about myself, right? So for me, I started trading sometime back while I was in university, right? That is about maybe 8 years ago. In university. So one fine day, I had a broker coming down to my school and they organized a trading competition. So this trading competition is it's just a friendly competition, right? And I took part in it, thinking, how difficult can the competition be? So I took part in the trading competition, and within 2 days, I blew up my trading account. And this was officially the start of my trading career. So after blowing up the trading account, right, and I decided to, I wanted to learn more about trading because I thought it was pretty intriguing, right? I thought it's pretty simple. It's just go long, go short, and that's how you make money. But after blowing up the trading account, I realized that it's actually more than meets the eye. So that's it, right? I decided to, educate myself in trading because at that point in time, being a university student, right, I think we can conclude that our pocket is pretty tight. We are not, willing to spend, just $3, $4, $5,000 on trading courses. So with that, right, I decided to, teach myself how to trade. So I probably have went through the same route as you, right? I go on to forums, reading books, YouTube, whatever you can think of. Chances are I probably attempted it. So I guess my first trading strategy was in this forum, right? I think Baby Pips is a forum that most of you are familiar with. So in this forum, there is this thread, right, where someone is actually massively being followed. So when you see someone's being followed, right, the person has to be good. Right? I mean, can't be people are all wrong following someone that isn't good. So in this thread, I started to learn about Bollinger Bands. This was officially the first trading strategy that I was taught. So this strategy went something like this, right? In the Bollinger Bands, we have the upper and lower bands. So it's something like he taught us to go long near the lows of the band and to take your profits near the high of the bands. Something like this, right? You go long over here, you take profit over here. Once you take profit, you go short and you take profit at the lower end of the band. So go long, you make money, go short, you make money, go long, you make money, go short, you make money. So on hindsight, this seems like really a really profitable way to trade. And only until I traded it myself, then I realized there's pretty much more to it. So the first strategy was officially Bollinger Bands. I have no need to lie to you that I actually lost money trading this strategy. So after trading Bollinger Bands, I guess the next course of action is I conclude that I think it's a very common phenomenon where traders use indicators, they lose money, and they start concluding that indicators are lagging, right? We are not we are supposed to trade with a naked chart. So that was the kind of notion I had. I need to trade with a naked chart. So this brought me into what I call the price action trading realm. So price action trading, right? I mean, so-called what was taught out there is something like you draw your area of support, you let price come into an area of support, and you wait for a reversal pattern, like maybe the pin bar, the engulfing pattern, right? So for example, this one you have an engulfing pattern. So you go long at the open, stop loss below the low, and you look to take profit at this high over here. So this was pretty much a very typical price action trading strategy, that you probably come across. So I also applied this strategy, and again, right, didn't really worked out for me as well. So that's it, right? At this point in time, I'm starting to think that perhaps trading is not so simple, right? Maybe the approach that I'm trading is way too simple. So I needed a more complicating set of trading strategies. So then again, right, I started moving on and come across stuff like what they call harmonic patterns. Not sure if any of you heard it, right? So the next step in my trading career was harmonic patterns, right? So in this trading strategy is basically using Fibonacci ratios and for it to align at a certain area before taking a trade. So if, for example, right, for harmonic patterns, they typically have 5 leg to a structure. They call this the X8 leg, the A leg, the B leg, the C leg, and the D leg. So the D leg is usually the termination point, where price would tend to reverse. So again, right, I studied harmonics, studied price action, studied indicators, and at this point in time, right after trading for about, I think this was about close to 3 years already, and still, right, the results I had just clearly wasn't what I was expecting, right? At this point I was just about to graduate from university. I graduated with a first class honor, and in terms of trading, I basically flunked it big time, right? I couldn't even make money after 3 years. So needless to say, right, I'm not sure if any of you experienced this, but it was just basically plain frustration, right? It's like you're thinking that you put in so much effort into something, but it's just not working out. So at this point in time, I graduated from university, but I knew one thing for sure is that I couldn't trade well, and I wanted to be a trader. So needless to say, in Singapore, from where I'm from, the way going forward was to land a job in trading. So I wanted a job that deals with the financial markets. I wanted a job that let me trade. So I guess the only logical route for me at that point in time was to get a role in proprietary trading. So that was basically what I did, right? I started looking for proprietary trading jobs. So I guess across, I think, everywhere, different countries, right? I believe proprietary trading roles are not easy to come by. In Singapore, they typically advertise a few times per year. Personally, I spent anywhere from about almost 6 months before I landed my role in a prop trading firm. I think I got rejected by more than 5 firms or 10 firms. I physically went down to the firms to hand down my resume and got rejected flat, or I failed the interview, blah blah blah. So it's after 6 months, finally, bam, right, landed a role in a prop trading firm. So for those of you who have no idea what's a prop trading firm, it's basically a firm, right, that back you financially to trade the markets. So from where I was from, right, when I started, right, they don't require you to put up any money up front. Everything is financially backed by the firm. The only thing they want from you is your commitment and, of course, your youth and your time, right? There is huge opportunity cost, because while at a prop trading firm, you're not paid. Well, at least for me, I wasn't paid with a fixed salary. It's more of a you have to either make money from the markets, or you go home empty for the month. So that's it. I was at a prop firm for about 2 years, and I would say I was fortunate, right, to be having the opportunity to trade different trading styles, right? For example, I tried, we had day trading, we have spreading, we have intraday, swing trading, position trading, and order flow trading. So I was fortunate, to have all the technology and facilities to explore the different types of trading. So while at the firm, I was mainly an intraday trader and a scalper. And after 2 years, right, at the firm, I think to myself that, I knew that this is something that is not sustainable in the long run. Because at the firm, I was doing anywhere from 12 to 14 hours a day. And think about this, I don't think any one of you wants to, be trading 14 hours a day, right? Is trading, 14 hours a day to you? I believe not, right? So I knew that, no, this is not something for the long run, right? When I'm 50 or 60 years old, this is definitely something not I want to do. So that said, after 2 years, I left the firm, right? And to trade on my own. So after I left the firm, I was mainly trading as a swing trader and a position trend follower. So that is my take, right? I was mainly trading off the higher time frames. And so, needless to say, I have some time on my hands. So while I have some time on my hands, right, I started, to find some meaning in what I do. And at this point in time, kind of, I find out that, the internet, right, talking about the trading aspect, have something lacking, which I feel that I can fill in the void. So this was where I started trading with Rainer, to basically pen down my thoughts based on my trading experience, right? So whatever I shared down there is all based solely on my experience for what works for me and what didn't work for me. So again, I could be wrong. I could really be wrong, right? But again, as I've mentioned, this is all based on my own experience and what has worked for me. So trading with Rainer is basically an avenue to provide, education to new and aspiring traders who may, find it useful. So that's it. That is basically, how trading with Rainer came about. And some of you may know, right? This is my wife, Jamie. We got married, I think 1 or 2 years ago. When I got married, I think 1 year ago. And recently, right, we have a baby daughter. Her name is Jay. And yeah, I think for those of you who have been following me, right, you probably know a little bit of my family affairs. So this is basically what I'm doing right now, right? I'm trading for myself, managing the website, the education portion, and being a husband, being a dad. So that basically sums up, right, what I do right now. So that's it. That's a little bit about me. And okay, just a quick check, right? Someone said there's no sound. Is the sound check beautiful? Okay on your side? Just a quick run through to see, are y'all having difficulty hearing, or is it just happen to be the person? Okay, so I think most of you are good or perfect hearing. So I think chances are it's just our friend who can't hear. Okay, beautiful. So okay, that's it. That is a my own story. So let's do a poll, right? So let's do a poll to maybe, for me to know you better. So since you know me a little bit, now it's my turn to know you. So I'll just, have a quick poll, a few questions, a yes, no question, so I get to know you better. So once I know you better, I can actually, create future content that is more relevant to you. So that's it. Don't worry. The poll is basically anonymous. I have no idea who choose what answers. In fact, I don't even know who is who down here. Everybody is, the name is friend. So the results will be in percentage terms reflected back to me. So don't worry, right? Your whatever answers is pretty much, anonymous. Okay, so this is the poll. Okay, so the first question is, how long have you all been trading? So I can share the results with you. So I think it's quite diversified, right? Some of I think it's pretty equal across the board, right? About the most is 30% of you have been trading for 1 or 2 years, and yeah, that's pretty much. I think we have pretty much different, a broad spectrum of traders, right? We have less than 1 year, 24%, more than 1 to 2 years, 30%, 3 to 5 years, 23%, more than 5 years, 23%. Okay, so let's hop on to the next question. How about this one? What do you hope to achieve out of trading? So some of us is, to grow your wealth, some is to earn a second income. Okay, so I think this is about 50-50, right? Some want trading to earn a second income, some want to grow their wealth. So I think although it may sound similar, but I think generating a second income require more consistency in trading, whereas growing your wealth, right, you can do it over a longer term horizon. Okay, so this another question. So which age group do you belong to? Okay, so I say majority are, of us here are between 26 to 45 years old. Right, the fourth question. How many kids? Any of you have kids? So don't worry, right? All answers are anonymous. I have no idea who is who, right? You can even be lying to me and I have no idea. And just the last question. Okay, with that's it, right? This is the poll, right? Just to know you better, right? Don't worry, right? All your answers, everything is anonymous. I have no idea who said what. So that's it. Let's move on with our today's webinar. So first and foremost, I want to talk about, why traders fail. I think this is an important aspect to talk about. And if you ask me, right, the main reason why traders fail, number one, is because they don't have an edge in the markets. So some would argue, oh, Rainer, all you need is just proper risk management. You just need to have the psychology, right? And you'll make money over time. And I can tell you flat out that is not true. If you don't believe me, right, you can just go down to a casino, right? If your area has a casino, you go down to the casino, right? Give yourself the best risk management, right? Prep yourself up with the best psychology, a psychiatrist or whatever. And if you go in down to the casino, you will still lose money over time. So this is apparent to you, clear that right now, as a trader, you need an edge in the markets. So don't worry, later on, I'm going to share with you a own strategy I use, right, that clearly has an edge for me. So that's it, an edge is important, right? Without an edge, right, you'll be losing to the transaction cost, you'll be losing towards the spread, and in the long run, you will lose money as a trader. Second reason why traders fail is because they don't have the right expectations of trading, right? They think that trading is something like, I have $1,000 and I want to make a living out of $1,000. And I can tell you, that's not going to happen, right? I'm not saying that it is not, I'm going to say this right now. It's not possible to make a living with $1,000. And again, it's not possible to take $1,000, turn it into $100,000 by the end of the year. Well, it's possible to take $1,000 to turn it to 100,000. But, it's a big but here. Chances are is that you end up blowing up your trading account along the way. So let me set this straight, right, into your expectations of trading. If you want to go and trade, I would say look at it in terms of percentage basis. Look at it in terms of R. I think this is a more objective way to gauge your own trading performance. So what is R? So R is a concept to illustrate, how much you're making in terms of risk. Let's say you make 1 R on a trade. So this means that if you are risking 1% on the trade, and if you make 1%, risking 1%, you have made 1 R. If you're risking 1% and you made, say, 3% on the trade, this is a 3R trade. So looking at trading in terms of R is definitely a more objective measure at it. So depending on your trading style, if you are trading off the higher time frames, you can look to make anywhere from 20 to 30 R in a year. All right, so have these expectations of trading. And also, right, if you think about this, if you make 25% a year, right, and you have $1,000 account, that is only $250. So traders will tell me, say, Rainer, $250 account, making $250 trading the market. Why don't you just don't waste my time, right? They're thinking that, I only make $250 trading the markets. But if you think about this, what if you have $1 million account? How much would that be worth to you? That's 250,000, right? You see, it is the same. 25% of 1,000 and 25% of $1 million. The only difference is your account size. So you can see that, in trading, it is better to look at it in terms of percentage gain, in terms of R, instead of looking, how much you want to make, right? Because how much you want to make is pretty much subjective and it's not an accurate measure. And the third thing why traders fail is this, right? They have the need to make money. So when you have the need to make money, this is a problem, right? A lot of traders, they attempt to, quit their full-time job to attempt, trading for a living. And when you attempt to trade for a living while keep quitting your full-time job, this creates a problem. What is the problem? Right? When you have this need to make money, it creates a psychological effect on you, right? Where you put on a trade and you tell yourself, oh man, I need to make money this month, right? I need to pay the bills, I need to feed my kids, I need to pay the mortgage, I need to pay the car, I need to make money. And when you have this need to make money, what's going to happen? You start taking suboptimal trading decisions, right? You take trading decisions like, let me widen my stop loss so I don't take a loss. Let me average into losers so, I can quickly, get back to break even, right? Yeah, that's right. Over trading, right? So you can see that the need to make money would create a lot of, negative or bad decisions in your trading. And when you do that, right, needless to say, you're not going to make money in the long run. Chances are you end up blowing up your trading account. Okay? So what you should not do, number one, right? If you have a full-time job, I'm here to tell you right now, don't day trade the markets. Don't do that. Why do I say that? Imagine, right? Let's say, I assume most of you, you work from 9 to 6. Is that how your hours is like? Most of you work from 9 to 6, 8 to 5? Is that how your schedule is like? I believe so, right? Those with full-time job, you work from 9 to 6. So if you are day trading, let's be honest, you are not going to trade from 9 to 6 because you're at work. So when are you going to trade? Well, you go back after work, right? Assuming you're in Singapore, you go back after work. You look to trade the New York Open all the way to maybe, London close. That's about 4 or 5 hours. So imagine, right? You have a full-time job at work. Work is already so stressful, right? Maybe politics, colleague, bosses, I don't know. And after work, you head home and you try to day trade the markets. And while you day trade the markets, you bring the pressure you have from work back to your trading. Right? It's like a boiler room, right? And on top of it, you're away from your friends. You're away from family time. You're away from, chilling out with your friends. So the kind of life you're leading, right, if you are day trading with a full-time job, is something like you wake up at 9 in the morning, 9 a.m. 9 a.m. you go to work, and you end your day at 12 midnight after trading. And I think this is a an approach that I wouldn't advise for those of you who have a full-time job. Similarly, what you shouldn't do is you shouldn't borrow money to trade, right? You saw earlier that you need a decent capital size to generate sufficient returns, right? Like $1 million, 25% is about 250,000. And some of you may think, okay, Rainer, so what I'm going to do is I'm going to borrow some money. I borrow money and then I have a sufficient capital size and I can trade well. Again, no, right? Think about this. If you borrow money to trade, what's going to happen? If you borrow money to trade, then you have the pressure to not lose the money, right? You tell yourself, okay, I can't lose this money, right? If I lose this money that I borrowed, I can't repay back the loan. Or if I lose too much, I may even be declared a bankrupt. So when you start having this kind of pressure, what is going to happen? Back to where we are, right? You're going to make suboptimal trading decisions. Again, back to square one. So what you should not do is, do not attempt to day trade because, again, you will not have a life outside of your work, right? You neglect your family and friends, and don't borrow money to trade. Okay, so this is key. So now brings us to the question, what should you do? All right, what you should do? Number one, keep your full-time job. All right, I think this is something that you may not like to hear, but I'm here to just give you the honest, brutal truth, right? Keep your full-time job. By keeping your full-time job, it helps in a few ways. Right? By having a full-time job, number one, what it does is this. It gives you the psychological comfort to know that you're financially secure month to month, right? You can pay the bills, you can feed your kids, you can do, you have a fixed income to pay whatever liabilities that you may have. And once you have this kind of psychological thought in your head, right, it becomes easy on trading because in terms of trading, you know that your bills are covered for the month or for the next few months because you have a job. So your focus in trading is just to get the process right? It's not to, break your rules because you do not have so much of an incentive to break the rules because you already have that comfort down there knowing that you are going to survive from month to month. So number one, keep your full-time job. It is going to help immensely a lot with your trading. Number two, what should you do? I would advocate trading off the higher time frame, right? You can trade off either position trading or swing trading. This helps a lot again because, again, why do I advocate the trading of the higher time frames, especially those who have a full-time job, right? Because the benefits of trading the higher time frame is this. Number one, little screen time. Well, little screen time compared to those who are day trading, right? Because you are managing your trades of the higher time frame, and you don't really need to spend a lot of time monitoring the trades. For example, if you trade off the daily charts, every single day is only going to paint one candle on your platform. So this is why you don't really need much screen time compared to those with a full-time job. Who are trading intraday. So that said, little screen time will bring you freedom, right? You have the freedom to basically carry on with your life, your work-life balance, work-life trading, everything is all balanced, right? You have time to trade, you have time for family, and you have time for work. And if you ask me, it basically gives you greater odds of trading success. Imagine, right? Every month, the bills are settled, right? And trading is just an avenue for you to grow your wealth over time to earn a second income from trading. So this really gives you a greater odds of trading success. And if you ask me, for a retail trader who have a full-time job, this is, I would say, the best way to go about being a profitable trader. Okay, so these are the benefits of position trading. So now I want to share with you one thing, right? Some of you may wonder, okay, Rainer, we are a retail trader. So what is our edge over, those professional traders, those institutions like the banks or, those funds out there? What is our edge? And let me share with you and tell you that you have an edge that, the other institution and, pro traders may not have, right? Let's talk of, for example, a bank trader. A bank trader primary role is to provide liquidity in the market, to provide to their clients, right? For example, Deutsche Bank. I say hedge fund ABC wants to get a quote on euro dollar, so he calls up Deutsche Bank and say, hey, give me a quote on euro dollar, and the trader may say, okay, 135 offer and 34 bid. So that's basically the quote he offer the hedge fund, and the hedge fund may say, okay, fill me 1 yard of euro dollars. So 1 yard basically is telling the bank to sell him $1 billion worth of euro dollars. So the bank trader can't say, no, I can't sell you that, right? Because the trend is against me. Or no, I can't sell you that because we are too exposed to euro dollars. Or no, I can't sell you that because it would amplify our risk. The trader can't say that. The trader have to say they have to fill in no matter what, because their role is to provide liquidity in the market. So the bank trader has to take the trade. And after which, right, how he hedge or mitigate the risk is entirely up to the trader itself. So this is one, right? This is what a bank trader has to do. Second thing, a mutual fund, right? I'm not sure if you know what a mutual fund is. They are basically a fund that try, to buy certain stocks of in the markets to beat, the index. And the thing about mutual funds is that about 85 to 90% don't even beat the index. And for mutual funds, they also have their own constraints, right? For example, most mutual funds, they have to stay long or stay on cash, right? They can't short the market. So because I think this is a constraint on them. So mutual funds, for example, if the market is collapsing, they can't go short on stocks. They either have to be on cash. And when mutual fund is staying on cash, investors will start probing them. Why are you on cash? Why aren't you, going out to make money for me? So mutual fund is, again, right, the PR down there is not having an easy role. So what is my point? What is your advantage over the traders at the bank or at the mutual funds? And if you ask me, I would say your greatest edge is having the liberty to go long, to go short, and to trade when you want to trade. Right? There are traders from those institutional side, they don't have this option to trade when they want to trade. They don't have the option to even go short, for example, for mutual funds. So this is something that a retail trader have. Right? You can choose how much size you want to use. You can choose when you want to trade. Maybe you just want to go long in an uptrend. You can only go, or you want to go long when price comes to an area of support. These are things that you can control, that you can do. Where institutional side of things, right, they do not have this liberty or this option. Okay, so for you, this is one of your greatest edge as a retail trader. So now with that said, right, you're probably wondering, okay, Rainer, I've come across so many different trading strategies, right? So, and I have no idea, what works or what doesn't work. So, maybe you want something that, that works, right? And I'm going to share with you something that has worked for me, and I hope it worked for you too as well. So what I'm going to introduce to you is what I call trend following, right? Trend following is a trading methodology. And the beauty about it is that it is backed by academic research. Means there have been studies going into trend following that shows that it generates a positive expectancy in the long run. All right, you can look at this research for those of you who are interested. 2 centuries of trend following by M. Potters, right? He basically studied the trend following methodology over the last 200 years and conclude that trend following generated, positive returns. You can check out the works of Alex Griesemann, right? Trend following with managed futures, who realized that, trend following actually, thrive in crisis period, meaning that trend following, they work very well in the, for example, dot-com bubble, in the 08-09 financial crisis, right? Trend following do very well in this period. And on top of it, right, if you want to look at systematic trend following, you can check out the works of Andreas Klenow, right? Following the trend as well. And on top of it, right, trend following, some of you may wonder, Rainer, what about those I know, right? It's all theory, right? You may be thinking, oh, it's all theory. What about the practical side of things, right? The practical side of things, right? You can check out Market Wizards, right? Richard Dennis, he made about 400 million in the 1980s. Ed Sekoda, Larry Light. What do all three of them have in common? They're all trend followers, right? And you may think, right? Okay, Market Wizards. Now, what about hedge funds, right? Hedge funds like Dune, Malvern, Winton Capital, they all adopt a trend following approach as well. So trend following is, number one, backed by academic research. Number two, it is practical in the real world because it's used by Market Wizards, right? It's adopted by all these top performing hedge funds. So what exactly is trend following? Right? So you may be thinking, what exactly is trend following? So let me break it down to you what trend following is all about. So trend following is not a strategy itself. Instead, trend following, if you ask me, is a methodology. It's a methodology to trade the markets. So methodology will be at the top of the tier, and below methodology, you have different types of trading strategy, like strategy 1, strategy 2, strategy 3, right? And most of these trend following hedge funds, they all have different trend following strategies. Some are more long term, some are shorter term, some are medium term, right? And so the key thing to understand is that, right, after this webinar, whether you go out in the days ahead and you want to learn a new strategy, I think a key question you need to ask yourself is that which methodology does your strategy fall into? Is it a trend following strategy? Is it maybe a counter trend strategy? Is it a seasonal strategy, or maybe a systematic strategy? So you need to ask yourself which methodology it falls into. And for the trend following methodology, it is based on 5 principles of trend following. So I would say all trend followers I come across, right, they all base their trading on these 5 principles. So what I'm going to share with you right now is basically the 5 principles of trend following. So once you've understood these 5 principles, you can then use it and develop your own trend following strategies. Okay, so what are these 5 principles of trend following? Let's have a look at it. Number 1, it's buy high and sell low. This is the first principle. And I know that it may sound a little weird to you. I mean, Rainer, are you kidding me? You want me to buy high and sell low when the teaching is to buy low and sell high? So for trend following, right, you can buy high and sell low. And I'm not saying that it's wrong to buy low and sell high, but for trend following, we just do it in the other way. We like to buy high and sell low. And the reason why I think most traders have difficulty accepting this is that it goes against our what you call values that is imparted to us. Say for example, when I was younger, right, where I will go out to the supermarket with my mom, and then I see some groceries and I look some apples and I see apples, and I want to buy some apples. I ask my mom, hey mom, can I get some apples? Right, it's selling $3-4, and my mom would say, yeah, that's a fair price, right? Go ahead and get some apples. And then I get some apples. The next week I come back around, I look at apples. It's selling for $3-10. So I ask my mom, hey mom, apples is selling for $3-10. Can I get some? She said no, right? Go and get some other alternative like orange. So I look at orange. Orange is selling at $3-4. Okay, fair enough. So I get some orange because it's at a fair price. So the following week I go back. Apples is selling for $3-10. Orange is $3-10. And I ask my mom, hey mom, apples and oranges, they are selling both $3-10. What do? And she tell me, Rainer, get lost. Well, she didn't tell me to get lost, but she meant it in a way, to don't bother buying fruits for that week, right? So this is just an example on how, since young, right, I think most of us are wired to buy low and sell high, right? It challenges our core values. And the problem with, wanting to buy low and sell high in the markets is that you miss trading opportunities in the market. Let's say, for example, you look at this chart. Doesn't really matter what chart is this, but I can tell, I think all of us can agree that this is pretty darn high, right? Look at this. It's the right side of the chart. You'll say that, oh man, Rainer, the market is overbought, right? I'm not looking to long here because it can reverse anytime now. Maybe I should go short, right? And if that is your thought process, then you have to look at this, right? What happened next is that price had this retracement and then it rallied another 1,200 pips. So this is what happens when you look to buy low and sell high. You will miss trading opportunities like this. Another example over here, you look at this chart. Oh, look at how low it is, all right? It is oversold, right? It can't go any lower, right? So you tell yourself you're not going to short. Maybe you go long, right? Try to be a contrarian, try, predict the low of the market. And if that's what you intend to do, then you can see over here, price just, slide even lower. This was the low, this was the oversold area, and it smashed another 2,000 pips. So what is my point? What is my point? My point is this, right? What is high can go higher, and what's low can go lower, right? The market is never too high to long or too low to short, right? This is my point. Okay? So now this brings us into the second principle of trend following. It's this: just follow price. Sounds simple, but again, this is something that a lot of traders fail to do. So if price is trading higher, right, just look to long, right? Your role as a trader is to look to long. If price is trading lower, you look to short. Simple as it is. So one thing that I want to caution you is that you as a trader, first and foremost, your primary concern is with what they call price, right? I understand some of you use fundamentals with your trading analysis, a combination of both, and that is perfectly fine. But the last thing you want to do as a trader, right, is to use fundamentals as a basis for your trading, right? This is a recipe for disaster. What do I mean by it, right? If you look at this, say for example, this is the chart of euro dollar, and this is an area of support. And let's say, right, Draghi announces, we are going to defend this 135 level, right? We're going to peg it to the euro dollar. We want to defend it. So if you are a trader who trades based on fundamentals and you see this, right, you tell yourself, okay, I'll go long in 135 since this is clearly a level that is, backed by the government, right, institution. So I can't go wrong, going long at 135. So if you have this mindset, trading based on fundamentals, then you'll go long over there. But ask yourself, what happens if price crack below the level? Well, if you are trading based on fundamentals, you'll tell yourself, oh, price is even, the value is even, cheaper right now. I should go even long even more. So you average in, and I don't really have to say what happens next if you, average into your losers all the way, right? You probably, wipe out your account or even multiple accounts, all right? Because you think about this, if you are entering your trades based on fundamentals, then it would only be logically if you exit your trades based on fundamentals. And if you exit your trades based on fundamentals and maybe over here Draghi announced that say, oh, we are not going to stick to the pack anymore. And by the time you've already blown up your account. So that is why I mentioned, if you want to trade the markets, fundamentals shouldn't be your primary basis for trading decision. I would say price is your primary basis. Okay? So that's it. Okay, let me see how I can fix this too. Why is my slides moving? Okay, give me a while. Okay, so pardon me for a while because with the slides, I can't seem to push my slides. So what I'm going to do is to get back my slides. Aha, got it. Okay, so the next example is this, right? If you look at this chart, for example, you see this is crude oil. Let's say, for example, again, you read some fundamental news and you say crude oil, right? The production level, right? $77 is a level of support, right? It's a production level where price cannot go below it, because if it goes below it, right, companies will close shop, right? People will get unemployed. So this is the production level of crude oil. And if you, again, base your trading decision on this piece of fundamental news, right, thinking that $77 have to hold, then I'm sure you know what happened next after to crude oil, right? It slumped to a low of $30, $40. So again, I'm not saying that fundamentals is bad. All I'm saying is that if you are a trader, fundamentals should not form the basis of your trading decision, right? You can use it to complement your own technical analysis, but do not use it for trading decision. You want to use it for investment, that is fine, but not for trading. Okay? So what's the key takeaway? The key takeaway is that for a trader, your key focus is price, right? Don't predict what the markets will do. Just follow price. Okay, so now I'm thirsty. Let me get a sip of water. So that's it. Now you may have some thoughts, right? Some of you may wonder, Reina, how do you write trends in the market? So the next principle of trend following, right, I'm going to share with you the only way that you're going to write massive trends in the market. The only way you're going to write trends in the market, really massive one, is this: to have no profit targets. All right, there is no way, right? Think about this. There is no way you're going to capture a trend in the market if you have a profit target. Think about what a profit target means. A profit target means is that you're telling the markets, okay, stop giving me, profits. It is too much. I have enough, right? I'm going to exit my trade because you're giving me too much profits. This is what you're telling the markets when you have a profit and if you have a profit target. All right, if you want to capture trends in the market, you have to let it ride. You cannot exit your trade ahead of time because you are basically cutting your profit short. Now, don't get me wrong, right? I'm not saying having a profit target is wrong. It is perfectly fine for those who are swing trading, trying to capture a swing in the market. But if you're a trader trying to capture trend, then having a profit target clearly doesn't make sense. Does that rhyme? I think so. Okay? So again, right, if you want to ride a trend, you can't have profit targets. So let's look at an example, right? Doesn't really matter what chart this is, all right? Let's say you went short at this area of resistance over here. And you tell yourself, right, you want to capture a trend. And then you see price coming into this area of support over here. And you tell yourself, okay, area of support, buyers may come in. Let me exit my trade. So you exit your trade at the area of support and you miss this entire sell down over here. So can you see, right? If you want to write trends in the market, it is impossible to do it by having a profit target. So instead, what you could do is, okay, the drawing is messing me up. I need to figure out how to, fix this changing of slide. Right, give me a moment because I'm trying to change my slides, but this monitor is apparently not working too well in my favor. So I need to, figure why that is so. Okay. So a better way to go about it is to learn how to trail your stop loss. So how you can go about trailing your stop loss, all right? There are different ways to trail your stop loss, all right? For example, you can use, let's see, right? There are different ways to trail, right? For example, moving average is one. You can use based on structure of the markets, higher high, higher lows. Systematic traders would use the average true range to trail your stop loss. But the key thing is letting your trade run, right? So these are different ways you can trail your stop loss. And in this example, I use this blue line over here, which is the 50 period moving average. So you can exit if price closes above it. So this is one way you can go about, right, trailing your stop loss. Another example over here, right? Let's say in this chart, you look at here and you say, okay, I decided to go short at this retracement and you want to ride the trend. But the moment price come into this swing low over here, right, you start to get panicky, right? You think that, you know, buyers may come in, you look to take your profits. And once you do that, you miss this entire sell down once again. Okay, so I believe I got my point across. A way you can go about it is again, right, to trail your stop loss using a moving average. So what's the key takeaway? The key takeaway is this, is that the only way to ride trends in the market is to have no profit targets, right? The thing is that there is no right or wrong, because if some of you are a swing trader, then it's perfectly fine, right, to have profit targets, because it allows you to capture swings in the market, but not for someone who is looking to capture trends in the market. So in case any of you are wondering what's the difference between a swing trader and a position and a trend follower, let me just briefly run you through. Say for example, right, this is a trend. A swing trader would typically look to enter on a pullback, right, and take profits at this high over here. So this is basically one swing in the market. So a swing trader is looking to capture this swing. Whereas a trend follower, someone who looks to capture a trend, what they do is, if there is a trend, they would look to enter, say, somewhere here, right, starting of the trend, and as the trend, reverse, they look to exit here. So from this portion to this portion, right, this is where a trend follower will look to capture the move. So this is the main difference between someone who is attempting to ride a trend and someone who is attempting to capture a swing in the market. Okay? So you can conclude and say that, okay, Rainer, then that means the primary difference between a trend follower and a swing trader is their mode of exit. And you're right? I would say the main difference between a swing trader and a trend follower is the way they exit their trades. So that's it, right? So now you may be thinking, okay, Rainer, so I understand, you want to capture trends in the market, but we all know that, there's not many trends in the market. So how do we increase the odds of us capturing a trend, since the market tends to be in a range about 70% of the time? So what you can do, right, is to basically, right, increase the number of markets you're trading, right? If you are just trading, say, maybe, let's do some simple math, shall we, right? If you are trading 10 markets, then technically speaking, right, based on math, right, 3 markets will be trending at any one point in time. If you're trading about 50 markets, then you have a good chance of having about 15 markets which are trending at any one point in time. So this is why it's important, right, for a trend follower to actually trade a diversified market, right? As many markets as possible. In fact, markets of different sectors. You want to be involved in markets in currencies, markets in the agriculture, the wheat, markets in energy, metals, indices. This is basically one of the biggest secret of trend following, right? The more diversified the portfolio you're trading, the better the odds of you actually capturing a trend and staying diversified. Okay? To walk you through an example, right, in 2014, early 2014, right, if you pay attention to the currency market, is basically in this range over here for euro dollar. So for trend follower, this is pretty much a nightmare. You long the breakout, you short the breakdown, you long the breakup, you would be, whipsaw to quite badly. Aussie dollar, you can see, again, it's in a range as well, this portion, right? Not really going anywhere. Volatility is pretty much to, multi-year lows. But that's it. If you look at the other sectors, like for example, the grain markets, this is wheat. You can see that in this same period, wheat is pretty much putting a very decent trending move. Or how about the Bund, right? Bund is in a very clear uptrend, as you can see over here, right? Bund is basically the German 10-year bond. And the S&P as well, right? Very clear uptrend. So what is my point, right? My point again is, as a trend follower, you don't want to marry yourself to only a few markets, right? Because if you only, marry yourself to a few markets, like what I shared with you earlier, early 2014, right? If you only focus on the FX and you adopt a trend following approach, you're going to be chopped to death, pretty badly, right? So your only way out, or I would say a form of protection to be diversified, is to actually trade across a wide variety of markets. And you're wondering, market Rainer, which other markets should I trade? Look at the futures market. The futures have a variety of sectors, right? They have anywhere from, like I've mentioned, currency, indices, metals, energy, grains, and the list goes on. So you look at the list of different sectors in the futures market, and those are basically the market that you should be involved in to actually increase the odds of you capturing a trend, right? Trade across all markets to increase the odds of capturing a trend. Basically what I've said. So with that said, right, now you may be thinking, okay, Rainer, since I have a question here, we trade so many markets, right? Won't I be, increasing my risk if I'm trading across so many markets, right? So technically, well, you are increasing your risk, but this is where the fifth principle comes into play, because as a trend follower or any type of trader you are, we only risk a fraction of our equity, right? You always risk a fraction of your capital. Why is that? Because you have to allow your age to play out. If you think about this, right, you can have maybe a system that wins 50% of the time with an average of a 1 to 2 risk to reward, right? But if you do not have proper risk management, if you do not risk a fraction of your capital, you would end up blowing up your account before your age can even be played out, right? Let me share with you an example. Let's say hypothetically you have this scenario where you have this lose, 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 win, 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 and say you have two traders, right? John and Sally, right? Traders. John is an aggressive trader. He risks 30% on each trade. Sally, she's more conservative. She put in 1% on each trade. So if you look at what happens, right, for John, right, he loses minus 30%, minus 30%, minus 30%, minus 30%. By the fourth trade, John would end up blowing up his trading account. Whereas Sally, she have minus 1, minus 1, minus 1, minus 1, and 2, 2, 2. Why 2 is because the average win is about 1 to 2 risk to reward. So net off, Sally would have made a profit of 2% after these 7 trades. So you can see that two traders have the same exact system, but their risk management differs, right? The risk they put on each trade is different. And this end up having John blowing up his trading account and Sally being a profitable trader. So this is the importance of risk management. This is the importance of risking a fraction of your capital. This is very important. I don't care whether you're a swing trader, a trend follower, a day trader, a spread trader, whatever. This is important. This is a basic fundamental truth for all types of trading. I would say most types of trading. And on top of it, right, you don't want to encounter the risk of ruin. So what exactly is the risk of ruin? The risk of ruin is this, right? Look at this table over here. The risk of ruin is this. Say, for example, you have a loss of 50%. How much more do you have to get back to break even? Well, some traders have told me you need 100% to get back to break even. And this is true, right? Because some traders think you only need 50%, but this is wrong, right? You do simple math, right? If you have $10, you lost $5 and you left $5. From $5, you want to go back to $10. How much do you need to make? 100%, right? So you can see that this is the risk of ruin matrix, right? As you go down deeper and deeper drawdown, as you lose your account, right, 60, 70, 80%, I'll say this is pretty much near impossible to recover. Alright, for those of you who currently are having drawdown of 70% or 80%, I would say the truth hurts, right? It is quite unlikely that you'll recover back your losses, right? Because you can see, right, if you lose 80% of your account, you need 400% to get back to break even. And chances are this is very unlikely. Okay? So the risk of ruin is very real, very real. So the key takeaway is this, right? Is that amateur traders, they like to ask themselves, how much can I make, right? How much can I make from trading, Rainer? How much can I make on this trade? But that's the wrong way to look at it, right? Because the professional trader, they ask themselves, how much can I lose? Right? We always look at this in terms of this sequence. The risk you can lose first before the opportunity. Okay? So let me share with you a quick story, right? About risk. So back in my early days, right? Before I was even, attempting to trade the markets, I was somewhat of an investor. I was trying to emulate Warren Buffett. I'm sure you probably know who Warren Buffett is, right? He's basically, I would say, the most successful investor of our time. So I read a few books on him and I think that I can be the next Buffett. So I started to, buy some stocks. And one of the stock that I came across is called Yang Zhijiang. It's listed on the Singapore Stock Exchange. And I saw that, the fundamental looks good, right? The revenue, the P&L, the assets, the liabilities, everything is pretty healthy. Cash flow is good. So I went and long this stock, right? Thinking that, I'm going to hold this forever. Trying to be the next Buffett, right? Like he holds Coca-Cola for forever. So I long this stock at $1.79, 179. So I was feeling good about it, right? You buy a shares which clearly is backed by fundamental data, you will feel good. So the thing is this, right? When I went long at $1.79, shortly afterwards, right, I had to, go for a holiday to Krabi, right, with my friends. So when I went, to the plane, I landed on Krabi on the first day. This shares was trading at 170. Right, $1.70. So I was taken aback. I'm like, huh? I bought a fundamentally sound company and right now I just lost 9 cents like that. So, I was a little bit puzzled, a little bit lost, but in the grand scheme of things, I tell myself things will be fine because after all, you're buying shares which are, clearly is backed by fundamentals. Then the second day in Krabi, right, I checked the quotes. It's trading at $1.60. I lost another 10 cents. And again, right, this time around, I was starting to feel the queasiness, right, in my stomach. I didn't really, enjoy what, things were going on because I was losing money on this stock while trying to have fun in my holiday, right? So the third day came, right, it's trading at 150. And at this point in time, right, I basically was dreading the entire holiday. I was losing so much money on this stock called Yang Zhejiang when it's supposed to be, doing well because it has good fundamentals. So you can imagine, right? When I get back from Krabi, first thing when I land in Singapore, I sold off all the shares of Yang Zhejiang. I think I sold off at 135, if I'm not wrong. And I took a big loss on it. So what is my message down here? My message down here is that it doesn't matter whether you're an investor, you're a trader, or whatever. Whenever you put on a bet, a speculative bet, you have to ask yourself, how much can you lose? Or how much are you willing to lose? Not how much you can make. Right? This is a very powerful story that happened to me that changed my way in speculating the market. So from that incident on, right, I tell myself, no matter what I put on, right, I have to know how much I'm willing to lose. Right? If I do not know how much I can potentially lose, that trade is off. Right? And this has, result in me being the trader today. From that a investment, that sour investment that turned out to be, right, proved to be, a valuable lesson for me. Okay, so this is the importance of risk management, right? A pro trader asks himself how much he can lose, or she. So that's it, right? It's about 50 minutes into today's webinar, right? I think it's a good time to go for a 5 minutes break. When we come back, right, I'm going to walk you through a simple trend following strategy I use and share with you how you can actually optimize your own trading day to trade while having a full-time job. Does it sound good? Right, 5 minutes break and we'll carry on where we left off. All right? Okay, great. See you back here in 5 minutes time. So it's a good time to get some water, go and pee, get some sweets or whatever. And the time now in Singapore is about 9:53. We'll commence sharply at 9:57, right? To be fair to those who are punctual. Okay, I'm back. So are you guys back? Boys and girls, alright? I believe there are some females down here. Alright, just a show of hand to see, how many of you are back. Just type yes or type something so I have an idea. Okay, so with that, I think most of you are probably back, right? Yes times 1000. Alright, fantastic. So let's continue, right? So let's do a recap, right? So what are the 5 principles of trend following? Number 1, buy high and sell low, right? We like to buy high and sell low, right? We just follow price. We don't try and predict, say, the market is too high to long or too low to short. We just follow price, right? We don't have any profit targets because we want to ride a trend in the market. And right, as you've seen in the earlier examples, in order to ride a trend, you cannot have any profit targets. But what you can have instead is a trailing stop mechanism in place, right? You want to trade all markets to increase the odds of you capturing a trend. And last but not least, you want to risk a fraction of your trading capital. So with that said, right, using these 5 principles right now, I'm going to share with you a trading strategy that I use, right? It's one of them that I use to trade the markets, right? So this is a trend following strategy, and this is, I would say, catered towards those who have a full-time job, right? Because you are primarily trading off the daily charts. So one thing to note, right, before we talk about the strategy, is that I want to share with you 5 components that I think is essential for any trading strategy. The first component is this, is what I call the filter. Right, the filter is basically would dictate how you define what is an uptrend or what is a downtrend, or when you stay out of the markets. Right, this filter is important because it's a signal to say that you only can be long or you can only be short, or you have to stay out of this market. So this is a filter. The second thing is what I call location, right? Because, for example, you invest in properties, everything is location, location, location. And similarly for trading, right, it's all about location, right? The areas that you want to trade from. So location is again the second thing that you have to look for. The third thing, your trigger. How will you enter the trade? Will you, maybe wait for a confirmation like a candlestick pattern, or you wait for an MA crossover and stuff like that? Number 4 is what I call your stop loss. Where would you put your initial stop loss so you protect your downside? And the fifth thing is basically, right, your exit when you are right. So basically, how will you exit your trade if the trade goes in your favor? If it's a trend following trade, then you need to trail your stop loss. If it's a swing trade, then you have to set your profit target at a certain level. So every trading strategy would have these 5 components, right? I think these are all essential components for any trading strategy that you're trading. So for my strategies, I like to use the if-then syntax, right? So it makes it very objective, right? For example, if I'm a boy, then I'll wear a pants. If I'm a girl, then I'll wear a skirt. If I'm not a boy or a girl, then maybe I'll wear nothing, right? So using the if-then syntax, it makes things more concrete. It makes things more objective. So this first statement over here, right? If the 200-day moving average is pointing higher and price is above it, then it's an uptrend. So this is basically how I define an uptrend. It may be simple by nature, but it does work more often than not. Of course, you can have other definition the way you want to define. For example, I don't want to use the 200-day moving average. Maybe I want to use 250-day, or I want to use the 50 cross above the 150-day moving average, the golden cross or whatever. Right? This is fair enough, right? It's pretty much up to you into how you want to define the filter, right? The uptrend. Second line is this, right? If it's in an uptrend, then I'll wait for 2 tests at the dynamic support using the 20-50 period moving average. So you can see over here, what is this? This dynamic support using the 20-50 is what we call the location, right? The area where I want to do business, the area where I want to trade from. Okay? And if price tests the dynamic support twice, then I'll look to get long on the third test. This is my entry trigger. If I'm long, then I place a stop loss of 2 times the average true range from my entry. So this is my stop loss, right? My exit if I'm wrong. And if price goes in my favor, I'll look to take profits when the candle closes beyond the 50 period moving average. This is my exit if I'm right. So you can see that how this simple trading strategy has met the 5 components I just shared with you earlier. Alright? And just vice versa for downtrend, just the opposite. So just to walk you through a few charts, right? These are obviously just based on hindsight, right? In the real world, trading is going to be much more different, right? It's going to be more difficult because trading on hindsight is pretty much easy. So I'm just sharing with you this chart to illustrate to you how I look to enter, and exit these trades. So first and foremost, you can see this is a first test. then price traded lower, and this is the second test. Traded lower, this is the third test. So one question I get by traders is this, right? They ask me, Rainer, why isn't this a second test? Why isn't this a second test? Right? And just to share with you, the reason why I don't treat this as a second test, because I need price to take out this prior swing low first. When it trade below this swing low, and then you retest, this to me is the second test. What happens if you don't wait for price to break out of the low? Well, if it doesn't happen, then chances are it may transit into a range, right, where you keep testing like this area, you keep testing the area, right? But it's more of a range instead of one test. So this is why for me, a requirement is to let price take out the prior lows here before I conclude a second test. So you can see in this example, this is the third test, and there are a few options for you down here, right? Some traders who are more aggressive, they look to get short with a sell limit order in this area. That is fair enough. And there are traders who are more conservative, they prefer to wait for some sort of confirmation. For example, they wait for this candle to close lower before they go short. That is fine as well. So this is why I'll say this strategy here is I don't really expect you to use it identically, because we all have different personality and different, traits that will be expressed in our own trading strategy. Okay? So how I'll look to exit this trade is, again, right, a close above the 50 period moving average. This candle over here. When it closes above the 50 period moving average, I'll exit the trade. So of course, if you enter here, here, or here, right, chances are you'll be stopped out for a loss in this trade. Okay, so that's the first example. Another example over here, you can see over here, right, again, this is the first test. Now, why is this a second test? Because price is traded above this swing high and came back and retest. This is the second test. Price rallied higher, taking out this high and retest the third time. So only at the third time over here would I be looking to get long, right? We have a trend with us, right? By right, there should be a 200-day moving average, right? Looking something like this. We are in an area of value, right? This area of value defined by the 20-50 period moving average. So this is where I'll be looking to get long, right? Waiting for a trigger to get long. Okay? So again, right, how I trail my stop loss is I wait for price to close below this 50 period moving average, and I'll exit the trade. And another example to share with you, right? You can see over here, first test over here, price traded below this low, traded lower. Second test, traded below this low. This is the third test. So third test, I'll look to get short. So when I'm short, again, I'll trail my stop loss using the 50 period moving average. So I got stopped out over here as price closed above the 50 period moving average. So I think more important is, to understand the considerations. Okay? These are important considerations, because what I've shared with you is just the strategy that I use, but I don't expect you to use it identically, because as I've mentioned, we all have different personalities, right? And it's difficult. I've never met a trader who use a strategy identically as the other trader, right? Chances are is that they adopt the same trading principles, right? But they have to tweak the strategy to suit themselves, right? So here are some further considerations for you, all right? Do you wait for a confirmation before entering a trade? So this is something that, you have to ask yourself. Are you going to wait for a confirmation, right? Confirmation can come in the form of a pin bar, an engulfing pattern, a higher close, right? This can act as confirmation. Number two, right? You need to ask yourself, what or which time frames are you trading? Will you be trading off the daily time frames, the 4-hour time frames? For those of you who have a full-time job, I would actually advocate trading off the higher time frames, like the daily or the 4-hour time frame, right? Because this keeps it more manageable, right? With a full-time job, right? It can be pretty busy, right? If you're trading, off the 1 hour or the 15 minutes time frame, right? Having a full-time job is not possible to manage your trades. And also another important question, how much risk are you putting on each trade? For me personally, I risk 1% on each trade. And again, this is a question that you have to ask yourself. Some traders are more comfortable with 0.5, and that is perfectly fine as well. And again, you can tweak it into a swing trading trade. So what do I mean by, tweak it into a swing trade? So let me go back to the example and share with you again. So you can see over here, right? If you are someone who prefers to just take a swing in the market, in this example, for example, you go short on the third test, you can look to just take a swing in this market. So that means if price retraces lower back towards this low over here, you can look to take your profits near the lows. So in other words, you're just capturing a swing in the market instead of, capturing a trend. So needless to say, right, if you capture a swing in the market, your trading performance will be more consistent compared to a trend follower. But your profit, right, the winners will not be as large. So it's always a give and take kind of thing. So this is how we can actually tweak it into a swing trading approach for those of you who want to trade with the trend but decided to go for a swing trading approach instead. Okay, so these are the considerations, very important considerations that you need to ask yourself. I cannot answer these questions for you because I'm not you, right? So really think hard about this, right? This is really important, right? This is as important, if not more important, than the strategy itself. So now, how do you actually use the strategy and what you've learned and schedule it into your day, right? I think most of you have a full-time job or you're studying. So how do you actually schedule it into a timeline where you can trade the markets effectively, right, without quitting your full-time job? So this is a template which you can use, right, which I think is very useful. So you can see over here, right, this is your days, right? Monday, Tuesday, Wednesday, Thursday, Friday, the weekends. This is before work, at work, and after work. So how you go about doing it is, you start off at the weekends, right? Saturday and Sunday. So what I would advise is that do your homework on the weekends. So what I mean by homework is that you have a basket of markets that you're watching, and those markets, right? For example, you have your own filter, your own trend filter. Which markets which are currently trending, right? Highlighted up in your spreadsheet or something, right? Those are the markets that you want to pay attention to. So from there on, right, those markets which are trending, you want to check which are the ones which are clear or near towards your area or location that you want to trade from. So that's the second thing, right? So number one, you want to find out is which market is currently trending according to per your definition. Number two, right, you want to see which is coming near to your location where you want to trade from. So once you have these two nailed down, right, chances are you can filter out your basket of currencies to maybe say, let's say markets down to about 5 markets to look for on Monday. So when Monday comes, what do you do? Monday comes, right? Monday before work, what you do is you manage your trades, trail your stop loss, and put in new orders. So you put in new orders, is chances are these 5 markets which are maybe coming towards your setup or give you an entry trigger, you place your orders, right? If you have any existing positions, right, from previous trades from previous week that you need to manage your trades, that you need to adjust your stop loss, you do so in Monday morning as well. So after you've done that in the morning portion, right, you go out to work and you just act busy, right? I think most of us act busy at work. So after work, you come back home, right? You check your orders. Check whether the orders that you place in the morning, are they triggered? If they are triggered, right, you record down your trades, right, into your journal. And then you scan the markets for, any more, potential trading opportunities come Tuesday morning. So once you've done that, right, you can then proceed on to Tuesday, right? The next morning, again, you place your orders, right? Any potential setups that has occurred, you place your orders in Tuesday morning before work. And again, if you have any existing position, you manage those trades or trail your stop loss, right? After work on Tuesday, you go back home, you check your orders and see which markets you're filled. If you're filled on those markets, you record down your trades, right? And again, scan the markets for opportunity for the trading day on Wednesday. So you rinse, repeat, right? Wednesday, Thursday, Friday, and back to the weekends again. So this is typically, right, a schedule that I have prepared, which I think really makes sense for those of you who have a full-time job. And if you ask me, right, how much time do you need to devote to it? So again, right, I think this pretty much differs from traders to traders. Some traders, they work faster, some, maybe a little bit slower, but it's not really important. But as a rough estimate, I think your homework on the weekends, right, if you started out doing it for the first time, it may take anywhere from 1 to 2 hours. All right, filtering out the markets that you're looking at down into the selected few that you want to trade the following week. And come Monday morning, when you put in your orders in the market, right, and when you trail your stops or whatsoever, if you ask me, I think you should take no more than 15 minutes in the morning to do this, orders and stuff. And after work, it may be a little bit more busy because you need to record down your trades that you have been triggered in the morning. So this will take typically about maybe 30 minutes. So you can see, right, pretty much you're spending less than an hour a day, right, trading the markets. When I mean by trading the markets, I don't mean, right, learning the markets. It's more of like just placing orders and doing your trade journal. Of course, you need more time to review your trades, your journal, and continue your trading education. But in terms of the physical trading, right, the entering of orders, right, the journaling of your trades, it should take no more than an hour each day. Okay,